This is MacroVoices with hedge fund manager Erik Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Erik Townsend and Patrick Ceresna.
MacroVoices episode 303 was recorded on December 23rd, 2021. I'm Erik Townsend. Happy holidays. This episode is brought to you by Abaxx Technologies, pioneering the design of smarter markets that better serve the needs of both market participants and society as a whole, and by Escrow.com, the world's most secure online payment system from a counterparty risk perspective because the funds sit in escrow. Felder Report founder Jesse Felder joins me as this week's feature interview guest. Jesse disagrees with the disinflationary views that David Rosenberg and other guests have expressed on MacroVoices and will lay out his side of the story for why he sees secular inflation in our future. We'll also talk precious metals and much more. Then be sure to stay tuned for our postgame segment when Patrick's chart deck is titled, What's in Store for the New Year?
And I'm Patrick Ceresna. Now, Erik, let's jump to the S&P 500. After a pretty decisive drop on the Omicron, we're all the way right back to close to making 52-week new highs. What's in store for the market?
I think that we will probably continue to move higher, but I do think that it's very likely over the next few weeks that there's going to be some kind of panic when the news hits the tape that, oh my gosh, what we knew for certain was about to happen happened. If you think back to the beginning of the pandemic, when all the smart people knew in late January and early February that there was almost certainly a global pandemic coming, and the news media were ridiculing us as a bunch of fearmongers and nutcases and so forth. We had to wait quite a while, and finally, when the news was just so painfully clear that people couldn't ignore it, they woke up and the market crashed and crude oil prices started their decline and so on and so forth. I think we got another one of those coming, and it doesn't really make sense because Omicron doesn't have the hospitalization and death rates that the previous strains have. This could be good news, but it's going to result in an explosion in cases to the upside. So I do see significant risk over the next few weeks, but I think it's a buy the dip opportunity, not a reversal of the market.
All right, well, let's move on to the U.S. dollar index. As the market started getting wobbly last week, the dollar strengthened, but has been giving some of it back. We're more or less in a one-month trade range between 96 and 97. Any thoughts on where the next move in the dollar could be going?
No, I really don't. I would have said between 95.5 and 97, but okay, 96 and 97, one way or another, we're in a consolidation range. Until we get a closing print out of that range, there's really nothing to say.
All right, well, let's jump to crude oil because we obviously had a one-day big drop on Monday, or at least as the trading week began in the European session. And since then, crude oil rebounded and we're back to around the $73 level. And it looks like crude oil might want to go higher. Is there more bullishness to come?
I think there's a whole lot more bullishness to come, but with a big caveat. Let's start with inventory, though. Crude oil drawing down 4.7 million barrels. Great big drawdown, very bullish. Cushing, Oklahoma, building a very desperately needed 1.3 million barrels. Gasoline drawing down 719,000 barrels. Distillates drawing down 2.9 million barrels. U.S. production ticking down 100,000 barrels to 11.6 million barrels. With Omicron fears fading as well as bullish inventory, we've got a nice big upside in the market. Does look to me like there could be a lot more upside to come. In fact, I am super duper uber bullish of crude oil in 2022. Okay, if that's the case, why did I this morning take advantage of today's test of that 100-day moving average and actually go flat on all of my crude oil futures positions, replacing them with calls on crude oil futures, which normally is the less efficient way to do this trade? The reason is because I think that there's a big risk that the headlines of case counts exploding to the upside could panic the market. Now, I know what some of you are thinking. Come on, Erik, you think you're the only professional crude oil trader who's smart enough to have figured this out and to see that Omicron is not really likely to be as big of a deal as people fear? No, I don't think that. What I think is all the other professional crude oil traders are going to be on their holidays for the next week or so, and it's in thin liquidity holiday trading that really crazy things can happen in the crude oil market. So if during this thin liquidity period we have some kind of big headline come out about 250,000 or 500,000 cases per day in the United States being detected, and of course the news isn't bothering to report that there's really nothing close to the same number of hospitalizations and deaths that the prior strains had, well, that's going to panic the market lower. I'm not necessarily predicting that's going to happen, but if it does, I want to have plenty of dry powder. It could go the other way. We could see some bullish news that Omicron is confirmed to be not as big of a risk as we thought it was, in which case maybe I'll miss out on the upside. But you know what? There's a lot of upside to come, and I'm kind of on the sidelines for now, just to get through this holiday risk period of thin liquidity when I know crazy things can happen in the market. After that, unless the facts change, I intend to be very, very long and very, very bullish into the new year. And we also had a question from a listener in Tokyo about backwardation. I'm going to save that for the post-game segment so that we can discuss it with the context of a chart.
All right, Erik, let's touch on gold. Obviously, the last week just paused temporarily around the 1,800 level, give or take, trying to move higher, but more or less we're still in the 1,800 level on gold. You think that things are going to start having a bullish tilt here?
Well, we've got the first signs anyway. We're above all of the short-term moving averages now, and, it looks pretty good. As you said last week, though, I think 1833 is really the line in the sand that I want to see some closing prints above, and I want to see it stay above that level. That would be where I get confidence that the bull move is really on. Right now, if I look at this tape, it's definitely better than it was a week ago. We've still got some work to do.
And while all the global markets are moving, more or less treasuries have been just trade range bound, and basically between the 10-year treasury yield's been more or less around the 140 basis point to about 150 basis points, just chopping about. Anything in your mind going on in treasury markets, or is it just more of the same?
I would say the thing that surprises me the most is how little volatility there's been in 10-year yields. The way I look at this is it's pretty darn challenging to really interpret this macro picture of what the Fed's going to do now, what happens if there's a change in power, if the Democrats lose the House at the end of 2022, what's that going to mean in terms of who's the next Fed chair, what does that mean to all of the politics, blah, 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 blah. There's so much to figure out, and I would think as the market is trying to digest this, does the Fed really mean what they say, which is they're serious about tapering this time? We're really not going to bail the market out. Trust us. I don't think people do believe that. I think they don't believe it for good reason, but there's lots of conflicting stories. I would expect more volatility. Bottom line, though, I really don't have any directional view on where it's headed.
Well, this week's feature interview guest is Jesse Felder of the Felder Report. Now, Erik, why did we get Jesse on the show this week?
Patrick, it's been ages since we had Jesse on the program, and he's one of our listeners' favorite guests, so we were overdue to get him back. But more importantly, Jesse told us that he has some opposing views to those expressed by David Rosenberg and other guests here on MacroVoices who've expressed disinflationary views. So this is Jesse's opportunity to lay out his arguments for secular inflation, and I think you're really going to love this interview.
Erik's interview with Jesse Felder is coming up as MacroVoices continues right after this message from our sponsor.
This episode of MacroVoices was brought to you by Abex, a fintech company traded under ticker symbol ABXXF on the OTCQX in the United States and ABXX on the Equitas Neo in Canada. Abex was founded on the principle of creating market-based solutions to solve the world's most challenging problems. Two of these issues in particular, the energy transition and climate change, are creating once-in-a-generation opportunities for investors. Abex is leveraging proprietary Web 3.0 technologies to digitize and accelerate the velocity and security of commodity trading markets, beginning with liquefied natural gas and carbon. Investors seeking exposure to the fintech applications powering this new era of the ESG economy can visit www.abex.tech or www.abex.exchange, or check out ABXX on the Equitas Neo or ABXXF on the OTCQX exchanges.
And now, with this week's special guest, here's hedge fund manager Erik Townsend.
Joining me now is Jesse Felder, founder of the Felder Report, and Jesse has prepared a terrific slide deck to accompany today's interview. Registered users will find the download link in your Research Roundup email. If you don't have a Research Roundup email, it means you're not yet registered at MacroVoices.com. Just go to the homepage, MacroVoices.com, click the red button that says Looking for the Downloads. Jesse, it's great to have you back on the show. I know you've been listening in recent weeks to our other guests and the raging inflation-deflation debate that we've been having. What do you make of all this, and where do you stand on the battle?
Well, Erik, thanks for having me back on the show. I have to first applaud you for putting together just this fantastic resource. Your last few episodes I've listened to just provide a terrific balance regarding the inflation debate. It's been a terrific panel, and I've gotten a lot out of it. But I do come down on the side of inflation in terms of that debate, and I think it's more interesting to discuss the secular inflationary forces rather than cyclical. I don't think they're, after the latest readings we've seen, for CPI and PPI today, that anybody's debating about, cyclical inflation at this point. But to me, when Rosie brought up the 3 Ds of disinflation, that was something that was very fascinating to me, because I see those same dynamics as having shifted in the last 10 years from disinflationary forces to inflationary forces. If you just start with demographics, I think the IMF put out a report, 3-4 years ago, pointing out that demographics in the United States, actually globally, everywhere but Japan, we're seeing these increasing age dependency ratios of, more retirees than working population. And that is an inflationary dynamic. I think one of the things that people don't really appreciate is that in the wake of the financial crisis, I think we had a lot of baby boomers who were forced to stay in the workforce. They weren't, able to retire because their retirement accounts took a hit, and so they had to stay in the workforce longer than they otherwise would have, kind of artificially increasing the supply of labor for a period of time, acting as a disinflationary force. But what we saw with the pandemic was a total reversal of that, where all those folks said, hey, look, my retirement account's now up 300%, whatever, from, in the last decade, and I can now afford to retire, and I don't want to stay at work and get sick. So all those folks retired. And then you had, even further to that degree, a bunch of people who maybe were going to retire 5-10 years from now, who thought, you know what, I've just done so well with my retirement accounts. Why don't I retire early? And so we're seeing this dramatic decline, I think, in the working population relative to the non-working. And that is an inflationary force putting pressure on wages. And I think that's one of the factors we're seeing right now. That's a secular push that's in place, but it's been exacerbated by the pandemic. When you talk about debt as another disinflationary force, I think that's true for folks like me and you, Erik, who, if we get too indebted, we have to cut back on our spending. It hurts demand. But that's true for everybody but the federal government, who can print money to monetize the debt. I think that's another thing we've seen as part of the pandemic is this, when debt to GDP, gets to where it is, it's typically problematic for countries that can't, get away with money printing. The United States government has been getting away with it for the past, couple of years now. And obviously that's not disinflationary at all to be issuing $4 or $5 trillion in new debt and having the Fed, buy it all up. Has not been disinflationary. It's been absolutely inflationary. And I think the final thing that Rosie brought up, and I'm a big fan of his work, he talks about disruptive technology. And I think that's been true for a long time too. But if you look at what's happened in the economy in the last 10 years, we've seen a concentration of economic power in fewer and fewer companies. Who's disrupting Apple today? Who's disrupting Facebook today? Facebook and Google are maybe a good example of companies who have their finger on the pulse of who in social media is going to potentially disrupt Facebook. Well, it's Instagram. Well, we'll just buy them. And, same thing with Google. And so they've been able to make thousands and thousands of acquisitions to essentially shore up their position, their monopoly or duopoly positions that have really prevented from disruptive tech from exerting a disinflationary impact in recent years. And I would say Amazon is probably another example of this, where who's disrupting Amazon? nobody. In the pandemic, we saw that, sales already off of a huge base go up 40% or something insane. We've never really seen a company of that size see that type of growth. And they just have such a strong position in the market that they can't be disrupted. I think we're seeing this in wages too with Amazon. There was a good article in the Wall Street Journal recently that pointed out that, with Amazon paying $18 starting wage in its warehouses, it's putting pressure on every other employer across the country to raise wages. And they're telling in all these small towns, they were telling, the Wall Street Journal and whoever else cares to ask that we're paying 12, 13, 14, 15 bucks an hour, and we have to go to 18 just to compete with Amazon and try and get workers. And so this is actually feeding through into prices for the first time, since the creation of the internet. We're seeing internet prices increase. They've been in decline for a long period of time as technology was a disruptive force, but it hasn't been. So we're seeing, inflation even on internet prices. So to me, that also just points to the fact that disruptive technology is no longer that factor that it once was. I think there's one final D, and that's deglobalization. That's also exerting an inflationary impact. Now, I think we saw global trade peak in 2007. It took a hit during the financial crisis and has been in decline ever since. And obviously, Trump's trade war was an important chapter in that saga of deglobalization. And the pandemic has been another one where I think a lot of countries, especially the U.S., have noticed that this just-in-time manufacturing is potentially a national security issue, and that we need to go from just in time to just in case so that we don't have the shortages of really crucially important items to the economy and to our healthcare system and whatnot that we've had in recent years. So I look at these 3Ds and I call them the 4Ds of inflation, and I think they're all pointing towards higher inflationary impulses in the years ahead.
I want to reconcile this with something you and I have talked about quite a bit over the years, Jesse, which is valuations in the stock market. Because as much as people say quantitative easing was not inflationary, it certainly helped to inflate asset prices. And I guess you and I have had a conversation where we've said, at some point, this is unsustainable. We've got to see the asset prices correct. My question to you today is, what if they never correct? What if this inflation continues to the point where the value of the currency gets diluted, but nominal prices really never have a meaningful correction? Is that possible?
It's absolutely possible, but I do think that we would be seeing, inflation in earnings and revenues and things that would be supporting valuations alongside stock prices if it was a sustainable type of thing. And I think that's what a lot of people are looking to today, is that the stock market is going to protect me from inflation. And that's one potential rationalization for valuations today. But I don't think it's valid in that. One of the charts that I have in the slide deck addresses this, that if you look at the real earnings yield on the S&P 500, it's never been more deeply negative than it is today. And that just suggests to me that even inflation-adjusted valuations are just off the chart ridiculous. And so I think the only way that stocks broadly are going to protect you from inflation is if you see the inflation actually materialize into earnings. And I think when you're seeing wage inflation like you're seeing today, there are a lot of good indicators, leading indicators of profit margins. And today, and most of those are wage-based. And currently right now they're pointing towards a contraction in profit margins, which would be a cyclical problem for the stock market. That's popping up in other indicators that are in the chart deck too.
Jesse, let's go ahead and dive into your chart book. Starting on page 1, you've got the Buffett yardstick. What's that mean? What's this about?
Well, Warren Buffett back in, I think, 2000, 2001, wrote a pair of articles for Fortune magazine. He introduced this indicator, one of those, saying it's the best valuation metric out there. And the reason I agree with that is it has a high correlation to 10-year forward returns, which I'll get to in a second. But essentially, it is the total value of the stock market relative to the size of the economy. And if you look at this, it's absolutely amazing to me to see just how parabolic this blow off in valuations has been over the last 2 years. If you look back to 2000, we got to close to 200% of GDP on the stock market. We surpassed that level in 2018, 2019. But in the wake of the pandemic, we've seen valuations scream to levels that are almost double the peak of the dot-com mania. Look back to 1968, which was another important peak in the stock market, and we're almost triple the valuations that we saw in 1968. I also bring that up because that was really the last time we saw inflation become a problem for the Fed as it is today. So, if you do think we are seeing secular inflation that the Fed is going to, battle with for a period of time, an extended period of time, that's probably your nearest analog. I know you've had other guests on the show talk about the 40s, but to me, the valuations are so much higher than anything we've seen before that's an important thing to consider. I'm kind of quickly going through what I call the four legs of the trading table, or actually my friend Todd Harrison coined that term: fundamentals, sentiment, technicals, and macro, the four main things to kind of assess when looking at the broad stock market. Fundamentals is that Buffett yardstick. The next slide on 2 is what I've started to call the index of the volume of speculation. I think John Kenneth Galbraith referred to margin debt as the best indicator of the volume of speculation in the market. With this, I've normalized it by also comparing it to GDP, very much like the Buffett yardstick. And we've seen this too, just scream higher too. I think Rosie mentioned that we're over $900 billion in margin debt. It's so far beyond anything we've seen. And even when you normalize this leverage speculation to the size of the economy, we're off the charts. So speculation, sentiment is insane. Turn to chart 3. Technicals, the trend has been solidly higher for a long period of time. And the way to explain that is chart number 4, which, as you've explained through many episodes, Erik, it's a lot of this can be attributed to central bank largesse, I think is how you framed it. So Bank of America found that more than 50% of the moves in the stock market can be attributable to the change in the Fed's balance sheet. And this is just a visual picture of that. We saw a huge surge in the Fed's balance sheet last year, and the stock market has followed. That is now potentially flatlining with tapering. And so this is an interesting time to be looking at a lot of these other indicators. But to dig a little bit deeper into each one of these things, this is kind of what I referenced earlier, which is on chart 5. This is the Buffett yardstick, just flips upside down, along with the forward 10-year returns in the stock market. And this is about a negative 90% correlation between these things. And so to me, it's the best visual representation of the price you pay determines your rate of return. One of my favorite Buffett quotes: you pay a high price, you get a low rate of return, and vice versa. Because investors are paying the highest valuations in history, they're very likely to get the lowest returns. But this measure is not, obviously, as everyone knows, fundamentals are not a great tool for short-term timing. What is better is if you turn to chart 6. This is what I mentioned earlier, is this real earnings yield on the S&P 500. And it's the most deepest, it's gone the deepest in the negative territory that we've ever seen. It's inverted on the chart, so it kind of lines up better with the peaks and troughs in the stock market. You can see every time the real earnings yield has turned negative, it's preceded a period of trouble for the stock market. The last time it did before this recent time period was in early 2008, right before stocks went into their deep plunge. Before that was 2000. We saw it again in the early 80s before a bear market in 82, 83, and also in 1972, 73, we saw, or 73, 74, we saw the earnings yield turn negative right before that very painful 73, 74 bear market, where the Fed was forced to raise rates from 4 to 13% in a short period of time to try and battle inflation. So that suggests that from a fundamental standpoint, we are at a level relative to inflation that could be potentially a better short-term timing tool. And when you turn to chart 7, this is an indicator that I put together after listening to Stan Druckenmiller talk about his challenges in shorting the 2000 stock market .com mania. He was trying to short the market. He switched to long because he became so frustrated trying to short into March of 2000. He switched to long just as the market reversed lower and had its kind of a mini crash. And he decided to take a break from trading. But when he came back to the markets in the fall of 2000, he saw that the dollar, the oil price, and interest rates had all been rising for a period of time, and that trifecta was a good leading indicator of an earnings recession. And so I did some work on this, and I put together essentially a very simple metric that tracks the rate of change in those three major indicators. And you'll see, it's basically just flipped upside down on this chart. When you see those things surge, as they have recently, it's a pretty good tell. I mean, the magnitude is probably off on this, right? I mean, I saw interest rates and oil prices go from, negative or very almost negative on nominal interest rates to something not negative, significantly so. But we've seen rates go up, we've seen oil prices go up, the dollar's been strong. This points to an earnings recession next year. So this is another potentially short-term fundamental timing tool, which tells me that the earnings cycle is potentially turning down, and that's usually a time to be cautious in the market. If you turn to chart 8, this is true not just for the broad stock market, it's true for the biggest, most popular stocks in the market. This shows the valuation of Facebook, Apple, Amazon, Microsoft, and Google. And analysts expect the incredible revenue growth we've seen for these companies to decline to its lowest levels, basically to test its lowest levels of the past 10 years. So you pair these extreme valuations with rapidly falling revenue growth, and I think we have a potential problem for the FANG stocks here, which, because they've become such a massive part of the broad stock market, that it has important implications for the market generally. Chart 9 here is also another kind of fundamental indicator that I got from a Druckenmiller quote, where he talked about the best leading economic indicator he's ever found is the internal activity of the stock market. When you see those most cyclically sensitive sectors of the stock market roll over, it's a time to, I think as he said it, keep your eyes wide open. And we've seen, a lot of these sectors roll over in terms of relative strength. Retail, metals and mining, industrials, transports have all been relatively weak relative to the S&P 500, which points to a fundamental warning signal for me in the way that I look at this. And so all these things point to a natural slowdown in fundamentals, which I don't think markets are pricing in with the highest valuations in history, where their investors aren't quite factoring these things in. The next chart, 10, is more of a sentiment indicator, but it's also it can be an economic indicator. It depicts the sell to buy ratio of insiders. These are corporate executives and directors at the top companies in the S&P 500 and beyond. And the sell to buy ratio has just screamed higher in recent months to record highs for as far back as I have data. And Najat Sehun, who's done the most in-depth research on this that I've seen, I think he's at the University of Michigan, has found that this measure is very highly correlated with not just future 12-month returns in the stock market, but 12-month economic activity a year out. So this is the insiders, the top managers at corporate America telling you the economy is probably going to be weaker than most expect next year. And that stock market returns are also probably at risk over the next 12 months too. So from a sentiment standpoint, I think that's important, because when you contrast it with what's going on in margin debt, you have insiders. I wrote a recent blog post on my site. Insiders are basically saying sold to you, to retail. And so we see margin debt at record highs relative to GDP. But in terms of turning that into kind of more of a short-term timing mechanism, you can look at the 12-month rate of change in margin debt, and every time it's gone over 50%, like it has recently, it's represented a speculative blow-off top in the stock market. The last time it did before this recent episode was 2007 top, and 2000 before that. We saw it again in that early 80s prior to a bear market recession episode then, and again in 72, 73 before that painful bear market in 73, 74. So, sentiment is potentially rolling over after we saw this speculative blow off. The final sentiment chart here I'll share with you is on chart 12. An indicator that I put together after I visited with Jim Stack over the summer, who runs InvestTech. And he said he's watching a lot of these most popular speculative stocks in the market as a sort of canary in the coal mine for the speculative bubble in general. And that when the performance of these things rolls over, it's going to be a potential indicator for broader risk appetite. And so I put together my own indicator. This index, I call it the speculation index or stonks index, is made up of things like GameStop and AMC, Robinhood, MicroStrategy, which was a popular kind of Bitcoin play, but essentially some of the highest most popular meme stocks over the past couple of years. And this thing's absolutely collapsed in the past couple of months. I put out a chart book to my subscribers just last night with the title, The Canary Just Croaked, because I think this canary in the coal mine is now saying that, the risk appetite in the stock market is rolling over in a serious way, something to pay attention to. But Jim Stack mentioned something else to me when I was talking to him, and that it's fundamentals and sentiment are really good to pay attention to, but it's really technicals and macro that he learned from Marty Zweig, the great Marty Zweig, that are the most important in terms of market timing. So I have a couple of charts there. So chart 13 just basically displays the breadth in the NASDAQ over the past, basically since the start of the year. And with a lot of these economically sensitive stocks rolling over and some of the speculative favorites rolling over, we've seen breadth deteriorate significantly, especially in the NASDAQ. Back in February and March, we had 80-90% of stocks on the NASDAQ composite trading above their 200-day moving averages. Recently, when the NASDAQ hit new highs, we were only at 40%. So breadth has deteriorated, has been cut in half. And a healthy stock market is not one in which the majority of stocks are in technical downtrends. A healthy stock market is one when the vast majority, you have that 80-90% in technical uptrends. And one way that I track this, if you look at chart 14, is I track the number of Hindenburg omens that are triggered over a certain look-back period. Obviously, the Hindenburg omen itself was developed as a crash indicator, and it's not very good at that. It's developed a bad reputation for that. But the Hindenburg omen is essentially constructed. It's very simple. It's when you have more than 2.8% of the stocks on an index or an exchange trade above, a new 52-week high and also a 52-week low. And the 50-day rate of change is positive. So you have an uptrend, and you're well within new highs typically, and it's normal to see new highs of the components within that index. But it's not normal, it's not healthy to have a lot of new lows triggering. So when you have a lot of these indicators trigger over a 12-month period, in this case on the chart, we've seen 18 Hindenburg omens triggered on the NASDAQ over the last 12 months. And every time we've seen this type of breadth deterioration to this degree, it's resulted in either a serious correction or a bear market decline. So the last time we saw this was in the late summer of 2018, just prior to that fourth quarter sell-off, which was 20% decline. We saw it again in the summer of 2015 before that flash crash in August and the steep decline into the early months of 2016, excuse me. We saw it again in 2007. All these breadth warnings pick up. We actually got 20 Hindenburg omens then. And at the peak of the 2000, the dot-com mania in March of 2000, we saw, I think it was just 14 Hindenburg omens trigger, but over a 12-month period. So we're at a point where the breadth has deteriorated so significantly that I think we're having the sort of technical warnings that suggest it's time to pay attention to a lot of these other fundamental and sentiment things. And then finally, if we turn to macro, This is a chart that I can't remember where I got it from, but I think it might have been from the Nordea guys who do fantastic work. But it basically just charts, it's an indicator for excess liquidity. And it's another very simple kind of indicator that shows when M2 is growing faster than GDP, that represents growth in excess liquidity that benefits stock prices. When M2 growth slows down below the level of GDP growth, that represents a contraction of excess liquidity and is not great for stock prices. There's a darn good correlation here between these things. And you can see when excess liquidity, M2, is growing faster than the economy, stock prices do well and vice versa. This indicator's already gone pretty deeply into negative territory in recent months, even before the Fed has lifted a finger to start tapering. So to me, from a macro standpoint, we have liquidity already evaporating for the stock market, which is a potential problem paired with all these other things I'm discussing. And the Fed is now being pressured by today's PPI readings, CPI readings, political pressure from the Democratic Party. It's hard to imagine more pressure on the Fed than they're seeing today to ramp up its tightening. And so the Fed is potentially, what I'm worried about now is that the Fed's potentially waited so long that they're going to start tapering into already an economic downturn when excess liquidity is already being sucked out of the system. And they're going to be pushed into another classic Fed mistake.
Jesse, let's touch on a subject which is near and dear to many of our listeners' hearts. That's precious metals. I kind of feel like the predictions that we made came true. They really did debase the currency just like we thought they would. We thought that was going to mean gold prices would go through the roof, and they haven't. What's going on?
Well, I think there's two things going on right now. One is with risk appetites potentially, over the past couple of years, just screaming higher. People are looking for high beta. They're not looking for safe havens. And I think Ola did a good job of talking about this a few weeks ago with you, that it's probably going to take a risk off period to see people turn back to gold at this point. The way I figure it, though, with real rates so deeply negative, gold prices are deeply undervalued. And I look back to the previous bull market in gold prices. There's actually a really tight price analog between the bottom in gold prices in 2015-16 to today and the bottom in gold prices in 2000 to 2001. And in that period, there was, about a 2-year, from the 2000 bottom in gold prices to the 2011 top, there was a period, a 2-year sideways period in gold prices that lines up perfectly with today. And this is an analog I've been tracking for 3-4 years now. I've been astounded at how closely it has mirrored our recent experience. So what I think is going to change this is if we do see risk off, it's going to potentially be investors will be looking toward a safe haven again. But I think what also markets are pricing in right now is I think markets believe the Fed is going to do enough to rein in inflation. And I think the reason to buy gold is that you believe that that's just not the case, that the Fed is not going to. I mean, you look at a thing like the Taylor rule, right? The Taylor rule suggests the Fed funds rate should be almost 8% today. That's zero. Right. And they're printing more money on a monthly basis than ever before. And so to taper to zero and then raise rates to 8, it's not going to happen. Even to raise rates to, let's imagine, core CPI falls back next year to 3%. I think it was, Dudley, former New York Fed head, said the neutral rate, that would put the neutral rate at, 3 to 4%. So the Fed funds rate would have to go to 3, 4, 5% to rein in inflation, even with core at 3. I don't think the Fed can even do that much. Here's where I do agree with David Rosenberg: is I think that the Fed is probably going to be tapering and tightening policy dramatically into a downturn, and they might have to actually create a recession to rein in inflation. So, but at some point, the Fed is going to be pressured again to protect the stock market. So I think they really have a dilemma here. And I've framed this dilemma as the Fed has to choose between the devil and the deep blue sea. The devil is raise interest rates enough to create another crash in the stock market like we saw in 2008 and 2001, 2 before that. That's the devil you know. That's what they've seen happen in the past. The deep blue sea is the other option, which is, nope, we're going to protect the stock market at all costs at the risk of allowing inflationary expectations to become unanchored and to create an inflation spiral. And that's the deep blue sea. That's the thing we haven't seen yet. And I do think with where sentiment is in Washington, where sentiment is at the Fed in terms of their inflation framework and the adjustments that they've made in recent years, it's pretty clear to me that they're not willing to choose another, choose the devil. They're not really willing to choose another asset price bust, that they're much more willing to allow inflation to run hot. And so when push comes to shove, we're probably going to see a stock market correction. Who knows how deep that's going to have to go before the Fed, goes back to, we see another Powell pivot, just like we saw at Christmas of 2018. And so I think what's happening right now is the gold price has priced in a tightening of financial conditions, a tightening of monetary policy. I think it was B of A had pointed out that the dollar has now priced in a complete tapering to zero asset purchases and 2 or 3 rate hikes. And so I look at that as that's what's gold is priced in now too, is a tapering to zero and 2 or 3 rate hikes, maybe 4 rate hikes. So to any extent the Fed disappoints on that outcome, it's going to be bearish for the dollar, bullish for the gold price. And I think that probably the Fed's going to disappoint on that, that they might be able to taper to zero, maybe even do it by March, end of March. But if they start hiking rates and stuff into an earnings recession, into an economic slowdown, into a decline in excess liquidity, the stock market's going to decline to a point where they're going to be forced to pivot again. And that's probably the catalyst I see for gold prices to not just break out higher, but to a very meaningful degree. As I mentioned before, I track the negative the real interest rates, and essentially that's core CPI less the 30-year, the 30-year yield less core CPI versus the gold price. And right now it's saying that gold is significantly undervalued, that, we could easily break out to new highs on the gold price and go several $100 above those highs we saw last year.
Jesse, I know you do a lot of work looking at the relative value of, let's say, commodities versus the stocks and so forth. So as we talk about precious metals, the mining stocks haven't done all that well recently, although I suppose the metal hasn't done all that well. Where's the opportunity? Is it in the mining stocks? Is it in the metal itself? Is it a combination? How do you look at this market?
Well, one of my long-time rules that I've given myself is don't let macro concerns get in the way of taking advantage of good micro opportunities. And it's kind of in that vein. I do have concerns about the broad stock market, but when you look at the value segment of the market, I think there's a really terrific opportunity in this area. Value, the relative PE ratio of value stocks to growth stocks has never been more skewed in favor of value than it is today. And that says a lot about growth stocks being overvalued. But then when you look too at the value segment of the stock market, I'm seeing tons of value and opportunity in commodities type businesses, which, if to me, that's maybe one of the most poignant signs that investors aren't buying into this inflation thesis, that they're loaded to the gills with growth stocks that are obviously have benefited from disinflation for 15 years now, and value stocks have been hurt by disinflation. And so you look at a lot of these commodities and things, and for example, I like to find stocks that have large insider ownership and insider buying. And I just saw Kelsey Warren buy a ton of Energy Transfer for Partners this week. Energy stocks are still seeing massive insider buying. Harold Hamm over the past couple months has just bought another $30 million of Continental Resources. And in the mining stocks too, the gold mining stocks, I think we're seeing good insider buying, and the valuations. I mean, a lot of these stocks are trading less than 5 times enterprise value to EBITDA. Another area that I find terrific value in, I did a fascinating interview with my friend Todd Harrison, was the cannabis stocks. You look at the U.S. multi-state operators, and these things are so cheap. They're growing faster than the FANG stocks, and they trade at a fraction of the price in terms of valuation. And so I think for investors to, the key takeaway is probably try and reduce exposure to the biggest, most popular names in the stock market. Those would be the big growth, popular growth stocks, and take advantage of some of this, unusual value in a lot of these commodities-focused businesses.
Well, Jesse, I can't thank you enough for a terrific interview, but before I let you go, please tell our listeners a little bit more about what you do at the Felder Report.
Right. Well, I started blogging back in 2005 in the early days of blogs when I was living in Bend, Oregon, and I saw the housing bubble developing, and little old Bend became the most overvalued real estate market in the United States. So I thought I need an outlet for this. So I started blogging, and 15, 16 years later, I'm still putting up a weekly blog post just on observations about markets and whatnot. So that's the felderreport.com. I also put out a Saturday morning email. I do tons of reading and research, and every Saturday morning I send out the 5, most valuable either articles or charts that I found during the course of that week. And that's just a free thing. You can sign up there on the homepage.
And again, Jesse's website is thefelderreport.com. Patrick Ceresna and I will be back as MacroVoices continues right after this message from our sponsor. Escrow.com is the payment system for buying and selling anything of value: cars, boats, airplanes, jewelry, gemstones, fine art, collectibles, intellectual property rights, domain names, bringing in shipping containers from overseas, or even buying and selling entire businesses. It's simple to use. Either party sets up the transaction, then the buyer sends the funds to Escrow.com. The seller is then instructed to send the goods to the buyer to inspect. Within the inspection period, the buyer can return the items for any reason. After that, Escrow.com pays the seller immediately. Escrow.com is the world's most secure payment system from a counterparty risk perspective because the funds sit in escrow. Over 2 million customers have transacted over $5 billion on Escrow.com, and eBay and Shopify use it for cars, boats, luxury watches, and business sales. It's available in the United States, Canada, and Australian dollars, euros, and British pounds. Never buy or sell anything online unless you use Escrow.com. Escrow.com is a subsidiary of Freelancer.com, listed on the OTCQX Best Markets under the ticker symbol FLNCF, and the Australian Securities Exchange under the ticker FLN.
Now, back to your hosts, Erik Townsend and Patrick Ceresna.
Erik, it was great to have Jesse on the show. I really enjoyed his views on the markets in terms of how we are quite overbought and overdue for a correction in many ways. I really wanted to put some of that into context through the chart, so we'll get to that here in a moment.
Well, I think that's exactly what we need to do, Patrick, because I'll tell you, listening to Jesse's interview myself, I thought, boy, he makes awfully compelling arguments, but how many times in the past have I made compelling arguments for this market being overbought, overvalued, and hey, it just keeps going up. And I think the explanation is central bank stimulus. Now we've got a promise from the Fed that they're going to taper, supposedly at least until things change. Let's see what happens. In any event, I want to jump into your post-game chart deck, which is titled, What is in Store for the New Year? Let's get into the charts and talk about how some of Jesse's views translate to the markets. Listeners, you'll find the download link in your Research Roundup email. If you don't have a Research Roundup email, it means you're not yet registered. Just go to macrovoices.com, click the red button on the homepage that says Looking for the Downloads. Patrick, let's jump into page 2, S&P 500. Boy, look at that change in trajectory going back to the beginning of 2020. Nothing like a global pandemic to really ignite upside in the stock market.
Right. I mean, almost every week we put up a chart of the S&P 500 using daily charts, which only usually captures a year of data. And I felt when listening to Jesse's interview and him highlighting a lot of the conditions that make this market so incredibly overbought and overdue for a correction, I thought zooming out and really putting this chart into perspective over the last 10, 15 years is really important. I mean, we go back to the 2009 market bottom and we just look at the bull market that has ensued, and it was quite the bull market, but really there has been an extraordinary acceleration of trend in the post-pandemic period, and this has really just had this huge rip to the upside that has made this almost exponential rise in these markets. And the question really here is, okay, if the markets are so overvalued and you have a scenario where potential returns are going to, in the future, be less just simply because of these high valuations. The question is it simply a fact that the market will suddenly start to be trade range bound after such an extraordinary move? Or will, when we had Julian Brigden come on and others talk about the fact that we're overdue for some sort of a correction? Now, when we look on the daily charts on page 3, we clearly have a market that looks like it's actually bullishly going to break out. Right now, there's no technical reason to actually believe that this that kind of scary bearish breakdown is imminent. And wouldn't it be interesting if the way this kind of played out was the market ends the year and starts the beginning of the new year with a big push towards 4,900 and 5,000 on the S&P. Everyone just goes all in, and then somewhere in the latter part of the first quarter, potentially a correction comes in. The point I'm trying to highlight is that while certainly we can make a lot of bear cases for the market, on the short-term technicals, there's not a lot of reason to believe that this is imminent.
Patrick, the nominal price of the S&P 500 has more than doubled since the March 2020 lows. That's not because global pandemics are good for the economy. It's because central bank stimulus is good for asset markets. So the big question is the Fed serious when they say that they're going to taper and they don't have the markets back and, don't count on us to bail out the stock market. That's not our job. We're here for the real economy. I don't believe that. I think that what's most likely to happen is this market continues to melt up until we get the beginnings, maybe, of a crash. And that's when the Fed is going to change their tune. Now, if they actually say what they mean and mean what they say, then we got a big crash coming ahead of us. But by the time it gets going, I think they're going to change their tune. In any event, Patrick, let's move on to page 4 and the volatility index, or the VIX. Seems like this latest vol spike is basically retracing out of the market.
Right. It's interesting. There's a lot of work out there by those that analyze volatility. And whenever you get a VIX that spikes above the 30 level, it usually marks one of two things: the beginning of some sort of a left tail market correction that is of serious magnitude, but more often than not, it marks a tradable low that creates a subsequent rally that could be anywhere in the 5 to 10% variety in the following 20 days. So when the VIX got up there, it was really an interesting moment to see whether it proved to be that buy on dip, which at this stage it really does look like it's the case. As the volatility heads down to the bottom end of its ranges, that adds like a tailwind to the markets and may actually continue to be, on the short term, some further fuel to actually drive a new high on the S&P. And this is goes back to that same narrative that we sort of talked about. Maybe on the very short term, the market is likely going higher, and all of those kind of scenarios of a bigger, deeper market correction that Julian Brigden and company have been talking about may be in store, but maybe it's something in the latter part of Q1 that could materialize. So moving on, Erik, I want to touch on page 5 here, the light crude oil futures. And what we can see is the December swing high that we had after that drop in prices is now being exceeded. And crude oil looks like it may actually want to head up back to the mid to high 70s. Maybe we might even see an $80 print. Certainly feels that way. Obviously, you were highlighting some short-term volatility risks over the holidays, and that's certainly something we'd have to take into account. Nonetheless, Erik, what's your thoughts on this chart?
Well, Patrick, this chart looks really good to me. If anything, I would be adding to my long position here if I were trading just on technicals in the chart, because we've got a very clear pattern. It looks like we put a bottom in. We've now got a series of both higher highs and higher lows. Everything's looking great about this chart. Why did I de-risk substantially in the last several days? Because I think that big, scary headlines are coming. I think the market is smart enough to know better and realize Omicron is more of a red herring and a nothing burger, because it's going to be off the charts in terms of cases. Everybody on the planet is going to get this thing. Frankly, I'm looking forward to contracting it myself so I can get it over with, because I know that it's coming, not just for me, but for everybody else. That headline could come during low volume, thin liquidity holiday trading hours. And if it does, it could crash the market down to $50. It's not that I predict that that's happening. I think the more likely case is the market keeps moving up and I end up missing out on some of the upside. But you know what? I think there's a whole lot more upside to come after that. And I just don't want to be super exposed during this holiday period. Could go the other way, and what happens is we get good news during the holidays and that thin liquidity takes us back over $80, and boy, I guess I really missed the boat. But let's move on to page 6, because we had a listener question about backwardation and why it exists in the crude oil term structure. Page 6 is showing us what's called a term structure chart. The leftmost yellow dot at the top left of that graph, right around $73, that's the January 2022 delivery contract for West Texas Intermediate crude oil. Each subsequent dot to the right of that going down is 1 month later. So the question to ask is, how do we interpret this? What message is it giving us when each subsequent contract costs less than the one before it? Now, the answer here is almost everybody, including professional futures traders, make the same mistake. The way they interpret the market until they learn how this really works, especially in crude oil, is they say, boy, the market seems to be predicting that prices are going to be lower in the future. Because right now, if you want to buy those futures contracts that are out into 2027, they're down there at $57, $58 as opposed to $73 to buy the current contract. So it seems as though, visually, just looking at this chart, that means the market is predicting that prices are headed lower. And that seems very much at odds with what I've said and a lot of other people have said about the lack of investment in new production, really leading to explosively higher prices in coming years. Well, believe it or not, that is what backwardation indicates. You would sort of think the opposite, because it seems like if the price is going to go up, you'd think the market would be in contango, where each subsequent month has a higher price. The thing is, contango basically creates a financial incentive for oil companies to leave oil in the ground, because they can get paid more by selling future-dated contracts than they can get by selling today's contracts. So there has to be some degree of backwardation to incentivize the oil producers to take the oil out of the ground. So believe it or not, the way this works is that when you see backwardation, the way to interpret it is the market's willing to pay a premium to get oil right now because we're afraid it's going to get more scarce and we want it now while we can lock in the price. That's what backwardation means. So when you look a year out on the chart and we see that, between, August of 23 and September of 23, still in backwardation there. What that means is the futures market is predicting that the physical market is going to stay tight all the way through that period. So backwardation actually is an indication of a tightening market, and it generally is bullish. It means prices are likely headed higher. Well, wait a minute. Something doesn't add up here. If prices are headed higher, and that's what this chart is telling us, doesn't that mean that there's an inefficiency here, which is the chart's saying it's predicting prices to go higher, but if I'm willing to buy a contract that's dated a year out, I can actually buy that at a deeply discounted price? Kind of doesn't make sense. Well, I agree, it doesn't really intuitively make sense, but that's how it works. And yes, you do have that opportunity. Well, isn't that a free lunch? How could it possibly be that way? The answer is, when you buy that contract that's a year out, you're getting a big discount, but you're also missing the roll premium that comes from rolling that contract forward every single month. So particularly in the Brent term structure, which is not shown here, you usually have the most backwardation at the very front of the curve. You're better off to just get the front month and roll it forward. With the WTI strip, I think you're better off to buy a little bit further out on the curve. I like the June and September of 22 contracts much better than the front month if you want to buy the recovery of the WTI contract. And the reason I say that is that the storage in Cushing, Oklahoma, is that rebuilds will eventually take some of that backwardation out of the very front of the curve. So that's a quick overview of how backwardation works, and it is exactly opposite of what you would expect in many ways. Let's move on to gold futures on page 7. Patrick, what do we see here?
Well, Erik, what I just wanted to highlight, I mean, we talk about where those moving averages near the 1800 level are on gold and where are some of the key hurdles to beat. But what I wanted to do was put a volume profile chart up to show where the vast majority of buyers and sellers were transacting on a volume by price basis. And what you can observe is that we have a substantial consolidation right where we're trading in this 1780 to 1810 area has a large amount of these high volume nodes. And to me, as we get above these moving averages and above these high volume nodes, that would be the first bullish constructive price action we would see in gold. And you can see that if gold was to get above the previous high around 1860, 1870, you would really start to open it up. And right now, I'd like to say that it's best to take almost a neutral approach to gold and let gold's price action do all the talking, because right here, we're right at a very critical pivot, and if gold is going to be bullish, it should start to show constructive breakouts out of these zones, which would be the first indication that maybe it's happening right here, right now.
Patrick, in the next few charts, we've got the grains. Why grains, and what do you see in these charts?
Well, Erik, wheat has been relatively bullish throughout the second half of this year, but one of the things that's bothered me is that it was not being confirmed by any sign of any bullishness on corn or the beans. And what we finally are seeing is a wheat chart that is turning up, but finally corn and soybean look like they have bottomed and are starting to constructively move higher. And this is something that I think is worth watching, because when you have all of them bulling together, sometimes when some of the best ag moves occur, you're seeing new breakouts in stocks like Nutrien and stocks like Mosaic turning up. It'll be interesting to see whether the ag story comes to life here.
Listeners, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Patrick's service, Big Picture Trading. Information is available on page 11 and 12 or bigpicturetrading.com. We're going to leave it there for this week's show. This episode is brought to you by Abex Technologies, pioneering the design of smarter markets that better serve the needs of both market participants and society as a whole. And by Escrow.com, the world's most secure online payment system from a counterparty risk perspective, because the funds sit in escrow. Patrick, tell them what's in this week's Research Roundup.
This week, you're going to find the transcript for today's interview, as well as a link to Jesse's slide deck and the chart book we just discussed here in the postgame. There's also a link to a Variant Perception article on gold divergences and a Bill Blaine Christmas special on energy transition and why we should not panic. You'll find this and so much more in this week's Research Roundup. So that does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make this program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account at MacroVoices for all the most recent updates and releases. You can also follow Erik on Twitter at Erik S. Townsend. That's Erik spelled with a K, and myself at Patrick Ceresna. On behalf of Erik Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Macro Voices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Erik Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.